Did you know that in 2026, thousands of New Zealanders could lose their life savings overnight? Not because of the market, but because of new financial rules nobody warned them about. Experts are raising the alarm. Banks, taxes, and government regulations are shifting faster than ever, and one misstep could leave your finances in ruins. Imagine waking up and realizing your mortgage, investments, or business could suddenly be illegal, overtaxed, or unprotected, all because you didn't know the rules had changed. From skyrocketing interest rates to hidden tax penalties, these 10 rules are designed to protect the system, but they could hurt your wallet if you're unprepared. In this video, we're breaking down each rule, showing you exactly what could go wrong and how to protect yourself before it's too late. Stick around. Rule number 1 is the one that could bankrupt anyone instantly.
Number 10. Ignoring interest rate cycles. One of the most overlooked dangers in New Zealand's financial landscape is interest rate fluctuations. Many homeowners and investors assume that their mortgage or loan will stay stable forever, but the reality is far more shocking. In 2026, economists predict that interest rates could rise sharply, impacting mortgages, personal loans, and business credit. Studies show that even a 2 to 3% increase can dramatically raise monthly payments, sometimes forcing families to cut essential expenses or, in extreme cases, face default. If you're relying solely on fixed or low-interest periods without planning, this rule could silently drain your finances. The solution is surprisingly simple, yet ignored by most. Financial experts recommend stress testing your budget. Calculate what your repayments would look like if rates increased by 2 to 5% and make adjustments now. Consider refinancing or securing a buffer fund to absorb sudden spikes. Additionally, diversifying your loans or investments can protect your wealth from the shockwaves of rising rates. Ignoring interest rate cycles is like walking a tightrope without a safety net. You might be fine today, but one sudden shift could throw your finances into chaos. Don't wait until it's too late. Take control now by reviewing your loans, creating a buffer, and preparing for sudden hikes. If you want to safeguard your money in 2026, like this video, subscribe, and comment below with which financial rule scares you.
Number 9. Living on variable debt. One of the most dangerous financial traps in New Zealand today is living on variable debt. From credit cards to buy now, pay later schemes, these debts may seem manageable when times are good, but a small shift in interest rates or financial conditions can send repayments skyrocketing. Recent studies reveal that nearly 40% of Kiwi households rely heavily on variable debt, and when combined with rising living costs, this can quickly spiral into unmanageable financial stress. Variable debt is appealing because it offers flexibility, but that very flexibility comes with hidden risks. Late payments, missed statements, or unexpected expenses can compound, creating a snowball effect that could jeopardize your credit score, savings, and future investments. Experts warn that without a solid repayment plan, anyone can find themselves trapped in a cycle that seems impossible to escape. The key is awareness and proactive management. Start by reviewing all your variable debts, prioritize high-interest accounts, and consider consolidating or switching to fixed-rate options if possible. Setting up automatic repayments ensures consistency and prevents penalties, while building a small emergency fund reduces reliance on borrowing for sudden expenses. Don't let variable debt silently erode your financial stability. Take action today. Like this video, subscribe for more urgent financial alerts, and comment below if you or someone you know is struggling with debt. By understanding this rule, you can protect yourself from one of the fastest routes to financial disaster in 2026.
Number 8. Failing to track inflation impact. Inflation is quietly eroding the value of money, and in 2026, New Zealand is predicted to face unprecedented price surges on essential goods, housing, and services. Many people fail to realize that even a moderate 5% inflation rate can drastically reduce your purchasing power over time. What seems like a small increase in grocery bills or rent today can translate into thousands of dollars lost over the year if you're unprepared. The danger is that inflation doesn't just affect spending, it also impacts investments, savings, and loan repayments. A fixed deposit or cash savings that doesn't account for inflation may actually lose value, while variable debts can grow heavier if interest rates rise in response. Ignoring these shifts can leave you financially exposed, especially if your budget assumes stability. The solution is active financial monitoring and strategic planning. Track how prices for essentials, utilities, and mortgages are changing. Adjust your investments toward options that outpace inflation, such as indexed funds or inflation-protected assets. Reevaluate your budget monthly and cut non-essential spending to maintain financial resilience. Don't let inflation silently drain your resources. Awareness is your first defense. Take control today. Like this video, subscribe for real-time financial updates, and comment below if inflation is already affecting your life. Understanding and adapting to this rule is critical to ensuring your wealth doesn't shrink unexpectedly in 2026.
Number 7. Ignoring tax changes and penalties. In 2026, New Zealand is set to introduce significant tax reforms that could catch property owners, investors, and even everyday earners completely off guard. Many Kiwis assume that the tax rules they know today will remain the same tomorrow, but failing to stay updated can lead to hefty fines, unexpected bills, and even legal consequences. Studies show that nearly 30% of taxpayers unknowingly miss critical changes, costing them thousands each year. These new rules affect everything from rental income and capital gains to business deductions and investment returns. Even small miscalculations can spiral into severe financial strain, especially if combined with late fees or penalties for underreporting. For property investors, the stakes are even higher. Missing a single compliance deadline can invalidate deductions or trigger audits. The solution is simple yet often overlooked. Stay informed and plan ahead. Subscribe to official updates from the Inland Revenue Department, review your filings carefully, and consult a certified tax professional if you're unsure. Maintaining clear records and proactively adjusting your finances ensures you won't be caught off guard. Don't wait until the tax authorities knock on your door. Protect your wealth by taking control now. Like this video, subscribe for urgent financial alerts, and comment below if you've already been affected by tax changes. Understanding rule number 7 is essential for anyone serious about safeguarding their finances in 2026. Being proactive now could save you thousands of dollars and immense stress in the months ahead.
Number 6. Overlooking property maintenance costs. One of the sneakiest ways property investors can lose money in New Zealand is by underestimating maintenance expenses. In 2026, experts warn that skyrocketing labor costs, rising material prices, and stricter building codes could make upkeep far more expensive than many landlords anticipate. Many property owners focus only on mortgage payments and rental income, ignoring the fact that neglected maintenance can quickly eat into profits or even lead to costly legal issues. Research shows that landlords who fail to budget adequately for repairs and inspections often face unexpected expenses that wipe out annual earnings. From plumbing issues to roof repairs or compliance updates for safety standards, these costs are unavoidable. Ignoring them can also lead to tenant disputes, lower occupancy, and potential fines under new regulations introduced this year. The solution is to plan ahead and create a maintenance fund. Experts recommend setting aside at least 5 to 10% of rental income for routine repairs and emergencies. Regular inspections, preventive maintenance, and hiring reliable contractors can reduce surprises. By proactively addressing property issues, you not only protect your investment, but also ensure tenants remain happy and your property retains value. Don't wait for unexpected repairs to drain your finances. Protect your investment today by liking this video, subscribing for more property and financial alerts, and commenting below with your experiences managing maintenance costs. Understanding Rule 6 is critical because even a single major repair could derail your 2026 investment plans if you're not prepared.
Number 5. Failing to account for rental market shifts. The New Zealand rental market is evolving rapidly, and in 2026, property investors must adapt or risk losing significant income. Experts are warning that tenant demands, government regulations, and economic pressures are reshaping the rental landscape, and those who ignore these shifts could face empty properties, reduced rental returns, or unexpected compliance costs. Many landlords rely on historical rental trends, assuming occupancy and pricing will remain stable. However, research indicates that nearly 25% of rental properties now face longer vacancy periods, especially in regions affected by new legislation or fluctuating demand. Failing to adjust rental rates, property features, or marketing strategies can lead to lost income and decreased property value. The key is staying proactive and flexible. Monitor local rental trends regularly, engage with tenants to understand their needs, and ensure your property remains attractive and competitive. Simple upgrades, such as energy-efficient appliances or improved safety measures, can not only increase rental income, but also reduce turnover and keep your property compliant. Ignoring the market isn't an option in 2026. Adaptation is your survival strategy. Take action now. Like this video, subscribe for urgent property and financial alerts, and comment below if you've noticed rental market changes affecting your income. Understanding Rule number 5 ensures you remain ahead of market fluctuations and protect your investment from sudden losses, keeping your rental income steady in a volatile landscape. Number 4. Ignoring tenancy compliance requirements. In 2026, New Zealand landlords face tougher tenancy laws than ever before, and failing to comply could cost you thousands or even result in legal action. Many property owners underestimate the complexity of these regulations, thinking that having a lease agreement is enough. However, new rules around healthy home standards, safety compliance, and tenant rights mean that even minor oversights can create major financial and legal risks. Studies reveal that landlords who ignore updated tenancy requirements are far more likely to face penalties, fines, or mandatory property upgrades, often at their own expense. For instance, failing to maintain heating, ventilation, or insulation standards can lead to formal complaints, loss of rental income, and costly emergency repairs. Additionally, tenant disputes arising from non-compliance can escalate quickly, tying up your time and finances. The solution is simple: stay informed and proactive. Regularly review all tenancy laws, conduct property inspections, and ensure your rental agreements fully comply with updated regulations. Consulting with tenancy experts or legal advisors can also help safeguard your investment. By taking these steps, you not only protect your finances, but also maintain a trustworthy reputation in the rental market. Don't risk penalties or tenant disputes. Take control today. Like this video, subscribe for urgent updates on New Zealand landlord laws, and comment below if you've already updated your property to comply with new requirements. Understanding Rule number 4 is crucial to staying ahead of legal changes and ensuring your rental property remains a safe, compliant, and profitable investment in 2026. Number 3. Overleveraging your property investments.
One of the most common mistakes New Zealand property investors make in 2026 is borrowing too much to expand their portfolio. Overleveraging, taking on excessive loans relative to your income or assets, can quickly turn a promising investment into a financial nightmare. Rising interest rates, stricter lending rules, and unpredictable market shifts mean that what seemed manageable last year could become unsustainable this year, putting your properties and personal finances at serious risk. Financial experts warn that investors who fail to maintain a balanced debt-to-income ratio are far more likely to face mortgage stress, forced sales, or bankruptcy if rental income dips or unexpected expenses arise. Even seasoned landlords can underestimate how sudden changes, like property market slowdowns, vacancy spikes, or maintenance emergencies, affect cash flow. The solution is straightforward: borrow responsibly and plan for worst-case scenarios. Always assess your capacity to cover mortgages, interest hikes, and unexpected costs without relying solely on rental income. Maintaining a safety buffer in your finances can protect you from sudden shocks and give you peace of mind. Don't risk losing everything by overextending yourself. Take control of your financial future today. Like this video, subscribe for critical property and financial updates, and comment below if you've taken steps to manage your leverage. Understanding rule number 3 is essential for anyone serious about maintaining a stable, profitable property portfolio in New Zealand in 2026.
Number 2. Neglecting property insurance coverage. In 2026, overlooking or underestimating property insurance could be a financial disaster for New Zealand landlords. Many investors assume their basic insurance policies will cover everything, but recent changes in regulations and natural disaster risks have made standard coverage insufficient. From earthquakes to floods, accidental damage, and tenant-related incidents, gaps in insurance can leave you personally liable for thousands of dollars in repair costs or legal claims. Experts warn that landlords who fail to regularly review and update their insurance policies are at a much higher risk of financial loss. Research shows that unexpected incidents account for a significant portion of property investment failures, and having inadequate insurance coverage amplifies the problem. Even properties in historically low-risk areas are not immune to natural events or tenant damages that can occur suddenly. The solution is simple yet crucial. Invest in comprehensive insurance and review your policies annually. Ensure coverage includes natural disasters, liability, loss of rental income, and tenant-related damages. Consulting with an insurance expert can help identify gaps and optimize your protection. By proactively safeguarding your property, you minimize risk, protect your income, and ensure peace of mind even during unforeseen events. Don't leave your investment vulnerable to disaster. Take action today. Like this video, subscribe for critical updates on New Zealand landlord laws, and comment below if you've reviewed your insurance policy recently. Understanding rule number 2 ensures your property is shielded from financial shocks and keeps your 2026 investment plans secure.
Number 1. Failing to monitor changes in tax laws. One of the most shocking risks for New Zealand property investors in 2026 is ignoring shifts in tax legislation. Experts warn that failing to stay up to date with tax changes could cost landlords thousands or even tens of thousands overnight. With new rules affecting rental income, capital gains, and allowable deductions, what worked last year may no longer apply, leaving property owners exposed to penalties, back taxes, or unexpected financial burdens. Research shows that many landlords underestimate the speed at which tax laws can change. For instance, alterations to depreciation rules, interest deductibility, or new compliance obligations can drastically affect your profitability. Ignoring these updates can result in surprise audits, fines, or reduced cash flow, jeopardizing your entire investment strategy.
The solution is clear. Actively monitor tax updates and seek professional advice. Regularly consulting a qualified accountant or tax advisor ensures that you understand new regulations and can adapt your financial planning accordingly. Proper record keeping, awareness of deductible expenses, and proactive planning can help you maximize profits while staying fully compliant. Don't let tax law changes catch you off guard. Protect your investment today. Like this video, subscribe for the latest updates on New Zealand property and tax laws, and comment below if you've reviewed your rental income strategy recently. Understanding rule number 1 is essential to maintaining a secure and profitable property portfolio in 2026, giving you the confidence to navigate a rapidly changing financial landscape.